Welcome to TheoTrade. This is Don Kaufman, July 10th, 2020. A few minutes after the cash close here on this Friday afternoon. Lovely Payson, Arizona. A little cooler up here in the mountains. Great place to be quarantined. Nevertheless, the S&Ps close on this Friday, and really the week following, of course, the holiday week of trade, ever so slightly higher. You know, the S&Ps really only finished up net about 55 handles. Nevertheless, the Nasdaq still continues its rip to the upside. We're going to look at that quite in depth. I mean, the marketplace. Just the last couple of weeks are throwing off everything you'd want to see in a marketplace, right? We got some exuberance to the upside. Come on, look no further than Tesla. I'm not necessarily saying I'm taking a short position inside of Tesla. Nevertheless, we are going to compare Tesla's market cap to several other major companies. And if you want to talk about, if you will, insanity of a market cap, you will find it specifically inside of Tesla, that in just the last few trading days, its market cap went up more than all of the other major car companies combined. That's right, that's just the last couple of trading sessions. Nevertheless, we move on to divergences, right? Now, it's the topic today. A little exuberance, some divergences, some volatility thrown in there. Divergences. You have to look at the Nasdaq right now, which is, again, on a rip to the upside. We're going to be looking at the Nasdaq versus the expected move. I've been talking about it extensively, but the divergence that we're seeing in just the last couple of trading days, first of all, it's throwing off some really sketchy trade, which I'll actually show you specifically when we get to a couple of charts and a few of the trade ideas. However, big time divergences in some of the monsters of tech. And when I talk about the monsters of tech, I'm talking about your Google, your Apple, your Facebook, your Amazon, your Microsoft. Those are collectively the monsters of tech. Nevertheless, again, throwing off some divergences, and we're going to look at the Nasdaq again in comparison to some of the other major index products as it's just pulling away at a record pace. There's the area for concern. That coupled with the fact that we have still some decent volatility. Let's talk for a moment, if you will, about the VIX, right? I think a lot of people are getting kind of lulled to sleep once again inside of the marketplace. I know we're coming out of some holiday kind of trading week, right? It's after July 4th, a little bit of hangover, doesn't matter, right? We still have a VIX in the 28, 29 region. You know, over the last 10 years, I would have begged, pleaded, anything for like a 30 VIX. Now we've got it. Ultimately, since what? The March kind of time frame, and most people, they've kind of been, again, lulled to sleep by the fact that the volatility is still up. You know, volatility coupled with, you know, wild, insane market caps, coupled with the fact that we're getting wild divergences inside of major index products. I mean, people, there is volatility staring us right in the face now. And we're also going to look at a couple of trade opportunities to specifically harness some of the volatility that we expect in the near future. Specifically, we're going to look at a couple of IV ranks. With that, let's get to work. Let's look at a couple of charts, a few trade ideas. All right, let's get down to it. A few charts and a couple of trade ideas before I jump deep into some really specific topics here. Again, we're going to talk a little bit about exuberance, some divergences, some volatility. As I said, it's everything you would want inside of a marketplace. But again, before I get there, I wanted to bring up just the general S&P. You know, talk about some strange things, obviously, in the marketplace. This is the S&P. It's a 1 day, 1 minute. Couldn't have a more linear move today. People, that's not like a bunch of traders sitting at home with emotion. This is an algorithm-driven trade, something like a VWAP spray, just driving S&Ps higher and higher. This is actually when you start to get into like negative gamma and start to squeeze a little higher. That's what it looks like. Again, people are never this linear. Machines, absolutely. Thought that was kind of a fun place to start here. But let's back out for a second to a 30-day 1 hour. And as I said, you know, this week was a little bit of a slop fest. I mean, last week was not dissimilar. But what did we do on the week? A whole lot of nothing. The S&Ps kind of slopped around a little bit. Net, we ended very slightly higher, specifically in the SPX on the week. But the S&P futures ended up pretty much where they kind of kicked off the week. So as I was saying, slop fest. Nevertheless, that slop fest still persisted in a fairly substantial range. All right, but let's get down to some overall topics here instead of referencing the slop fest of a marketplace. Few things. All right, first and foremost, Nasdaq, it just got downright sketchy. Now, I fully recognize that the Nasdaq is still chugging higher. All-time high. That's fairly easy to say. Why? When you actually pull out to a daily chart, it's consistently been at an all-time high. But one of the things that I keep kind of going back to is, and again, something I mentioned last week, it's the magnitude of the move that we're seeing. Okay, the sheer magnitude of this move inside of the Nasdaq. But what you're not seeing per se is how fast the Nasdaq is actually pulling away from the other major index products, which I'm going to show you here, momentarily. That's when I get to divergences are massive. Just hold me. Okay, we'll come back to that here momentarily. Before I get there, when I say the Nasdaq is downright sketchy, let me put, a kind of a face to that name. This is what I'm talking about with downright sketchy. There are fits of what I term bidless moments, short duration, bidless moments. And that's why I'm saying the Nasdaq is getting downright sketchy in here. This is right at the cash open, specifically today. Here we are in, July 10th on a Friday afternoon. You're like, that doesn't look like that much. The Nasdaq at the open, opened somewhere around 10,750. 3 minutes later, had actually already backed off to 10,690 before it found its final resting place down here. And again, a couple of bidless moments all the way to 10,660. For the most part, you had just shy of a 100-point drop inside of 1, 2, 3, 4, 5, 6, 7 minutes. The first 7 minutes, sheer terror, followed by, again, huge, just outsized moves. This doesn't look like that much. Just looking at a candle. It's a move from 10,675 down to the 40 handle. What's 35 Nasdaq points amongst friends in the middle of a 1 minute? Now, it's not just on Friday. Okay, the exact same thing was actually being felt overnight trade. Okay, and throughout the trading session, of course, on Thursday. Again, bidless moments. You better keep your eye on this in the very near future. It is again. It's downright scary in this particular case. Now, before I go any further, I also want to kind of elaborate a little bit on what we term the monsters of tech. This is something I was mentioning kind of in the video portion a moment ago. The monsters of tech, they've actually diverged lower and away from the S&Ps. So even though we see kind of the magnitude of this last move, the monsters of tech were only up 0.3% with the S&Ps, a full 1.2% by the end of the day. So all of a sudden, as the Nasdaq and specifically the monsters of tech are ripping away here on this Friday, they stalled. It's one of the key points that I wanted to make on here is the Nasdaq itself started to actually fail on a percentage level versus the other products. Now, again, I could spend all day on this, and I'm going to come back into the divergence in just a moment, but I also want to show you again the expected moves. So here we are, and this is something I was talking extensively about on the weekend update. Here we are. We now have 2 weeks, 2 consecutive weeks, not just outside the expected move, massively outside the expected move. And I have called for a fairly hideous pullback in the very near term inside of the QQQ. This is something whereby I'm actually, for me, I am buying out of the money put spreads because the put spreads are influenced by the skew. By buying out of the money put spreads, those put spreads are what I would assume to be a little bit cheaper because of the heavy implied volatility skew. But I'm buying out of the money put spreads, out, for example, out here, looking for just a quick kind of flash to the downside. It doesn't mean, and I don't want to be mistaken here, this doesn't mean that the Nasdaq is just going to continue to tear to the downside. All I need, is just a momentary lapse, one good down day for all of those out of the money put spreads to come to fruition. But I absolutely am looking for a violent but short-term violent pullback inside of the Nasdaq, given the fact that its divergences are so large. One last way that we can actually quantify this a little bit, if we kind of zoom out, I have a prefabricated style in here, and in this prefabricated style, I can actually compare It's the QQQ versus the spiders versus the IWM. And what I wanted you to see in this comparison is exactly, this is it's a great visual way to take a look at it. This is the Qs, this is the spiders, this is the IWM. And you're actually seeing the Qs literally pulling away from the other index products. The divergences are only growing, except specifically today. Today, the divergence, became what? Starting to flip over. That's why I was pointing, to the Nasdaq only being up 1% when, the financials actually lifted the S&Ps up a whopping what? 1.2%. So it's something to really think about. Again, in just the next couple of trading sessions, I'd expect at least a few real violent trading sessions. The Nasdaq could be once again a little bit of a bidless beast, if you will. And hopefully I described that some bidless moments there cause sheer terror for intraday traders. Next in the docket, exuberance in the overall marketplace. Now, I'm not going to go as far as Greenspan. It's irrational. You want a rational? I'll give you a rational. Okay, you got it. Tesla. Let's bring up Tesla for just a moment, right? Exuberance is found obviously inside of one product, and that's Tesla. So here on this Friday afternoon, it also finished up by the tune of approximately 11% today. But Tesla's been on an absolute tear to the upside. Earnings coming out neither here nor there. One of the points that I wanted to make with this, and I'm actually going to open it up, under stock highlights here. Let me just circle it for you. The market cap right now of Tesla, there it is. You're looking at approximately, let's call it $286 billion. $286 billion. Now, I didn't know exactly what to compare that to. So I came up with a kind of cool comparison. A little equation. Listen, I am a math geek, right? So I'm always going to put everything in equation terms, but I want to make sure everybody can understand this equation. Goldman Sachs has a $70 billion market cap, right? Add a little Caterpillar in there. Caterpillar has about a $70 billion market cap. And top that off with a Costco. Costco has about a $144 billion market cap. So what do you got? Tesla. Its market cap is the equivalent of Goldman Sachs, Caterpillar, and Costco combined. That should be just jaw-dropping to anybody. Now again, this is not me telling you that you should get short Tesla in any way, shape, or form. I don't think that this has anything to do with Tesla. I own a Tesla. I like my Tesla. I think it's wonderful. Elon Musk might be a few fries short of a Happy Meal, but that's neither here nor there. It doesn't matter what your feelings are, okay? All that matters is when you start to look at a marketplace, and I'm using Tesla, if you will, as the poster child, okay, for just abject stupidity in terms of a market cap. There is not, anybody in any way, shape, or form that can make a fundamental argument over here. Every car company is going out of business. Do you think that matters? Have you looked at other car companies and what their market caps happen to be? Right? Go look at something like, General Motors. Last time I looked, they still make a hell of a lot of cars. $35 billion market cap. Okay. Add a little Ford in there. Okay. Ford's in $24 billion market cap. I mean, I can go on for a half an hour about this. The point that I'm trying to make isn't about a long or short. It's about the entire marketplace. Okay. There's no valuation you're going to be able to put on there in any way, shape, or form. What you basically have, algorithms and people that are chasing, what? I mean, the insanity. All right. This is like trying to capture the Easter Bunny and Santa Claus all in the exact same stock. Right. And they'll keep performance chasing until it ends, and it ends horribly. But again, I'm not actually picking on Tesla in this case. I want you to understand that relates right back down to the Nasdaq. Okay. When we start to look at the valuations and people start to make arguments for things like Apple, which is, again, struggling right now to possibly even produce a super cycle for their phone. I could go off for hours just about a couple of the tech stocks in here. I just want you to understand that when you start seeing market caps like this, and again, I wasn't planning to bring up Apple, but sure, why not? You're looking at $1.66 trillion of a market cap. I know. In some ways, somebody's going to send me an email that it's worth it, baby. It's worth it. I'm sorry, but there's no way from a risk-reward standpoint. You have a company right now that is buying back their own stock. Okay, the Fed's out there, of course, buying their corporate bonds. They're buying back their own stock with some of that capital. Nevertheless, okay, again, as a firm, they can't even provide guidance to the forward future right now. They're shutting down some of the retail stores, even though that's not one of the bigger businesses. Again, fundamentals out the window, people. What I wanted to get to, that's why I'm talking about exuberance in the marketplace, because you're seeing it everywhere. Tesla, though, is the poster child for it. Next on the docket, earnings season. Yeah, it's again. Okay. The financials are up. I don't have that much to say about this other than this. When it comes to the financials, there is the overwhelming feeling that the financials are going to be ending up holding the bag of risk, okay, in the coronavirus kind of meltdown. There hasn't been a meltdown yet, but we do know at this point in time, a lot of people are out of work. There's about, 18 million in terms of continuing initial jobless claims. Well, those initial jobless claims, again, consistently, it's about 18 million, all right, that have remained on that kind of, docket there for jobless. With that, there's all kinds of mortgage fallout that is expected, anticipated. I do not believe any of that is really going to hit home in the near term. And when it comes to like a JP Morgan and a Citi, a Wells Fargo, they're going to start to provide guidance, okay, in some way, shape, or form. But that guidance, it's not what you expect. The guidance is going to be in relation to some of the loan fallout. And every one of these companies is possibly going to take, okay, an intentionally a huge loss to put aside massive amounts of capital. Be careful. This is not necessarily a negative. The market may applaud them for doing so. So the financials, wait for that bait and switch. I have got a back ratio spread sitting there 21 days out, looking for an explosion to the financials to the upside. If the financials do, in fact, rip to the upside, 2650, by the way, is kind of the Maginot line inside of the financials. We're more than a hop, skip, and a jump away from that. Nevertheless, okay, I would only look for a very short-term pop to the upside in the financials based on some of the earnings that are likely due out. That in the financials, there's just no love in here whatsoever. Again, year-to-date, they're still down almost 25% year-to-date basis. The financials, again, kind of sucking wind along, of course, with the energy sector. Nevertheless, one of the things is that's again, the financials aside. What I want to see, though, is that any company during these earnings, are they going to provide forward guidance? There's been a lack, obviously, of guidance. Everybody pulled guidance because of the unknown, the uncertainty in here. Let's see if anybody can actually provide guidance. Again, I do not necessarily believe that earnings is going to be pivotal to the overall marketplace. The marketplace right now, okay, is much, much more looking at some of the economic data that's coming out rather than individual companies and their earnings. So don't get me wrong over here. The earnings absolutely matter, okay? But I don't think it's going to be the vast market-moving event that most people kind of anticipate. Speaking of market-moving event, who says you can't buy iron condors? Well, we've been doing quite a number of what we term gamma iron condors. For those of you here that are at TheoTrade, we are going to have a full-blown course on gamma irons July 16th. July 16th during the trading day. I'm actually going to host the course during the trading day. It's going to run anywhere from 2 to 3 hours. We're going to talk extensively, though, about buying these iron condors. You go, why would anybody want to buy an iron condor? Well, because it's working. I'll actually start off here in like GLD. You can look at some of the closes inside of GLD. These iron condors have actually seen pretty good degrees of profitability. Again, that's GLD, but we haven't just hit one in GLD. We've actually hit them now in TLT. Okay, we hit one in the spiders. So if you want to look at just briefly here inside of the TLT, this is an open and a close, really short-term trade too. Gamma Iron opened it ultimately on July 7th, closed it July 10th. About a 33% gain on this one. Really short term, not looking for a home run. Okay, they're nice little quaint trades. You don't have to worry too much about them, but they're working, and they're working simply because the IV ranks are incredibly low. You have a lot of volatility in this marketplace. When you start looking stuff like TLT, its IV rank is at like 12%. Who doesn't want to be a net buyer of volatility? There's nothing, options, they're not a sale in this marketplace. I keep reiterating this. Options, net are a buy in this marketplace, and that's exactly what we're doing with gamma irons. And again, when you find something that works, you hold on to it like it is just, grim death. You just keep pressing forward. But as I said, we've done one in GLD. We've done one in TLT. We did one in the spiders. I liked it so much inside of the spiders, I went after it again. Okay, why the spiders at this point in time? Once again, it comes a lot down to like the IV rank, lower IV rank in here. I mean, implied volatility probably isn't going much lower, right? But we went out and we actually purchased another Iron Condor out here in the August timeframe. Those are the August monthlies, 42 days left to expiration. Plenty of gamma in there to have a party. All right, so with that, looked a little bit at the marketplace as a whole. We talked about the Nasdaq and the expectations the Nasdaq is getting downright sketchy. We looked at the fact that stocks like Tesla, okay, we've come to like never land. Earnings season is coming. Like, let's see if anybody actually provides guidance. By the way, again, I don't know if that guidance is going to be a market moving event, but I am amused. We talked a little bit about gamma irons because it's a trade that is absolutely hot right now. Last but definitely not least, you got to look at expected move. So expected move. Okay, we are in a period of time right here, right now. We cracked the expected move. We cracked the expected move. We cracked an expected move inside. Okay, inside, cracked an expected move inside. Now, this is kind of crazy because you're just looking back at what? X's and O's. Now, you're looking back at like, 6 weeks. Okay, and inside, that 6-week period, 3, okay, out of those 6, crack through the expected move. Now, what's interesting about that is this last week of trade. Again, this last week of trade, the expected move is about $80. We ended up inside the expected move, but then the irony was they lowered the expected move for the coming week just inside that even more. Now we're actually going to move into a $76 expected move. So you ask why I might be buying option premium. I'll tell you why I'm buying option premium. Because 3 out of the last 6 weeks, we ripped through the expected move. I don't even necessarily need a rip through the expected move. I just need a marketplace that's going to be volatile to the upside or the downside. And as I said, whatever's working, okay, is what I'm going to do. So I put on this Iron Condor 46 days out. All I really need is one good breach of expected move anytime, okay, in the next couple of weeks, and we're going to be home. This is why I'm doing it. Again, it's why I pay attention to things like expected move. Now, yeah, I just pointed out like the last 6 weeks, but net, since the, we'll call it the Corona kickoff, look how many of these weeks people have actually breached expected move. It just goes on and on and on and on and on, okay? All of these are major breaches of expected move. Sure, things quieted down in here for a little while, but all of a sudden, we're ripping apart again. Note, okay, and I'm telling you this, just because you're seeing the marketplace once again feel like it's exploiting to the upside, you are still seeing a marketplace that is showing signs of inefficiency. When I call it inefficiency, I'm calling it inefficiency simply in respect to the fact that we are continually breaking expected moves. That's not efficient. When a marketplace says you're supposed to move $80 and you move $90, that's not an efficient marketplace. Efficiency is staying inside the expected move. Okay? Expected move is supposed to occur 68% of the time. Does 50-50 look like 68%? Absolutely not. And again, that's short duration, but net this year, we've been just smoking through the expected move continuously. Hence why we're heavily on the buy side of options right now. Again, marketplace overall, exuberance, divergences, and volatility, should expect much more of that. But as I said again, that's everything you're ever going to want in a marketplace. Thanks, everybody, for tuning in to the Weekend Update. This is Don Kaufman. Have a wonderful weekend. Bye.